welcome to Property Matters here on Dublin South FM. You can contact the show on Twitter, Facebook, or indeed LinkedIn at iPropertyRadio, or email hello@iPropertyRadio.com. Your host for today is myself, Carol Tallon, and I'm delighted to be joined by Helen McCormack, owner of Helen McCormack Estate Agents based in Limerick. Helen, you're very welcome.
Thank you very much, Carol. It's lovely to be here and meet you today.
Well, I'm delighted to have a chance to speak to you because we know anecdotally that estate agents right around the country are exceptionally busy since we reopened. While the restrictions are still a challenge, I'm interested to hear the experience that you have, because you're working. I won't say one person operation, but you've a very small team down in Limerick. So I'm wondering, how has your company managed the last couple of months, and particularly the last couple of weeks of reopening?
Yeah, I mean, we've very much looked forward to reopening after the lockdown. We were extremely busy, however, during the lockdown because, it wasn't the first time that I myself have been through a difficult period, because we've lived through the last recession, so nothing was as bad as that. But at the same time, it's, very conscious of, it's not what happens, it's how you manage it. And, immediately the government went out and offered so many different incentives, and there was so much business coaching available as well, and programs. And, when the lockdown started, I went on a 14-week program myself about pivoting the business. And a huge pivot for me and many others that I can see as well in our industry was the move to social media, particularly when, there isn't visibility in terms of meeting your clients coming into the office. You think, well, visibility means credibility and ultimately, sales, lettings and profitability. So how do I make myself visible during this period? So believe it or not, up to then, even though the business was successful, didn't have a social media presence. So instantly the basics are the Facebook account, the Instagram account, start promoting properties, and then, myself on my own LinkedIn presence. And, so that kind of, gives you confidence as well that you're still out there, even though you're locked down, because at the time we didn't know how long this was going to go on for. So being out there then and seeing other agents, and that's a huge part of it. What I really enjoyed is, seeing faces maybe that I'd only seen at seminars or CPD events. And you're going, they're such and such high, and that's what they're doing. And you start to like it. And, previously there was a kind of all this competitive factor, between agents. And I think the social media has, really demonstrated how, we're all in different territories. So let's all support each other. And, I've said this before as well, to myself, that since the PSRA came in and the clear boundaries around client instructions, there isn't that competitive cutthroat piece between local agents, because the boundaries around the client instruction are so clear that it makes for really good relationships. So on top of that, plus the new, for a lot of us, presence on the likes of LinkedIn and social media, there's great camaraderie now and support, and we're bouncing off each other and getting ideas off each other. Some of the more braver of us have gone out and done video first, and others are following suit, which is great.
Helen, there's so much good stuff there in what you've said. Like, first of all, I'm genuinely surprised that, your business is more than a decade old, and yet you're only seeing the need for social media or a more online presence for yourself over lockdown. What was the marketing of the business like over the decade before that? Well,
I think like property, I think the property market and business is quite local, for me as, an independent trader with a manager in the office. So it's all local. So the business for me was all about building long-term relationships locally. So I would target business through networking groups in Limerick, and I'm still members of those groups as well. So we would refer business to each other. And then I think most growth in local businesses comes organically through satisfied customers who refer onto the next person. And, through the recovery in terms of the rental management sector, a lot of those rental managed properties organically turned into sales, which turned into further management and further sales. So there was a lot of organic growth. And if you get a good name locally, again, the name you can trust, that's really another issue that's often been a huge issue for our customers, is trust with estate agents. Is there transparency? Is there really a bid on that property? I can't believe we're still hearing that actually sometimes. because of the regulation. And, people don't like to be questioned that way. They have their own integrity. But all those issues were always out there. So, being able to build trust and relationships, I think property and the business and a good business and auctioneering and estate agency it's never about a one-hit wonder. It's always about the relationship and building relationships. And if you sell a house for someone's mom or dad, you get the son, daughter. Like there's a cycle of property. First of all, you're a student. You go in, you want your student rental. You come out, then you get a good job, or you get onto your employment career. You start saving for a mortgage. You need to rent during that period. Then you go into the first-time buyer sphere. Then, the family starts to grow. You might go into the second-time buyer sphere. You might move on then into your first investment property. So it's a lifelong relationship with people. And if you stay local, you can actually have that.
Yeah, Helen, you're dead right. It comes down to reputation. And, every week on the show, and indeed for the last number of years, I've had a very strong focus on technology. And I think maybe because I talk about technology and prop tech every week, that I maybe don't give the time to really reinforce the basics, which are, property really is about people. And the technology that's being used is just to enable the people working in property. And in terms of building trust, from my point of view, I think technology is a great way to bring transparency that feeds that trust. But there's so many ways to do that. And, in a way, when I have a conversation like this, it reminds me that, technology really is just the tool. But actually, the basic relationships in property really haven't changed so much. And in fact, if anything, they've probably gotten stronger. And that need for that need to be a trusted name in your locality has probably become even more pronounced over the last number of years. One of the things I've noticed is this move and this rise in independent estate agencies. We really saw that coming out of the last crash. And it was a trend we picked up on early. But it was a number of years before we had any stats to show that actually there has been a rise in independent estate agents in Ireland. Why do you think that is?
Well, I think there's a lot of, good salespeople working in the estate agency industry. There's a lot of people who put a high value on relationships. And people like to do business with people they know, like, and trust. So if in individual fields they're good at, and the Irish, I think, always have an entrepreneurial spirit. The overheads can be low because, you can take a smaller type office. So then if somebody's good at that and they're committed and dedicated, they feel, and they have a strong base. A lot of people have connections in the sporting groups. Limerick is a fantastic sporting city, and they feel they have a network that they would be able to justify having a business out of, could grow from there. And I think, it's just if you're dynamic and you're committed and, you feel maybe it's more financially viable to go out on your own, give it a shot, and you have your education and you can go for your license. It's a really good idea. And, so why not if people can?
Yeah. And look, geography does play a part. You're based in Limerick City. Limerick really feels like a city on the move. And, it's almost a cliche to say that because it feels like that's been said, for a number of years. But, we can see the really large scale projects that are happening, the big urban regeneration projects that are working both public and private. There's such an appetite there. Maybe give us some insight what it's like across the property market in Limerick at the moment.
Yeah, well, as you said, Carol, in relation to the city itself, I mean, I don't know if people outside Limerick realise this and if they've looked at the 2030 and 2041 vision for Limerick, the plans, but it's so exciting because Limerick and the Midwest now, not Limerick on its own, Limerick, which is the centre city of the Midwest region, which we call Clare, Tipperary, and Limerick, is going to be the next complement to Dublin, and a huge critical component of, our future economic growth. I mean, there's so much going on, starting with inside the city. I mean, you probably heard last week, LIT just achieved university status, which is phenomenal. We have UL, the Kenny Business School there, which is constantly growing. The opera site has now started as well. the development of the 10-acre site, previously the Cleves Toffee factory, which will take it's only 7 years. We all know that's going to fly. Like it's, 13 years since the property crash. Think about that. So there's amazing stuff and it's not something that's going to happen. It's already started. It's already happening. And then we have like the renovation of the Georgian Quarter as well. And that's another thing maybe people outside Limerick may not be aware of, that Limerick, next to Dublin, has the biggest Georgian Quarter in Ireland. And the plans there to actually, the investments to maybe bring people back in to live, renovate a lot of those properties. Some of them are actually vacant, and to live there residentially as well. So it's not even something that's going to happen. We're in it. It's happening. It's extremely exciting. The plan is really for Limerick and the Midwest to be the next Dublin. The infrastructure plans are in place and being developed as well. We have, the sporting capital, the cultural city, a very historical city. So it's very, very exciting. And, the multinationals, have always spotted Limerick as, and that's something that's going back 20, 30 years, have always spotted Limerick as, a place to watch. And they're in here now for all this growth. I mean, the building Northern Trust built, in the last few years is phenomenal. We've consistent growth in the pharmaceutical and all the huge companies we have since Regeneron came in here in 2014. And that has just drove on, the economy, the demand for property, everything. And it's actually continuing all the time because of the competitiveness, the education, the quality of the graduates, the quality of our third level institutions. The fact as well, I think Limerick has a lovely, you can live in the city, but yet feel you have this almost country kind of lifestyle, being able to connect to the Atlantic Way. Nobody complains about commuting. Like even 30 minutes, you can have, you can live in a beautiful rural place, like a lakeside town, between 30 and 50 minutes outside Limerick. So when you consider all that, I mean, the sky's the limit, isn't it, really, in terms of all the development?
Well, let's talk about affordability then, because Limerick certainly has a lot going for it. And that's been true for quite a long time. I'm not sure how well it's been marketed, though, in the past.
Yeah.
But in terms of, so there's a couple of big things. You already have UL, and now LIT has achieved university status. We're seeing this growing medtech and pharma industry, which, we would assume then that they're able to capture maybe some or certainly retain graduates. So they can maybe encourage graduates after they're finished their university training to actually stay in the region. And that's something that not all university towns and cities can do. But in terms of then buying and renting properties, can early stage career people actually afford to live and rent comfortably in Limerick?
They can at the moment, but prices are increasing. And Limerick, again, has seen huge increases in rents in the last 2 years in particular, but starting in the last 3 years. And, I have thought, ironically, the 4% rule, which, was brought in, due to the crisis situation in Dublin, and rightly so, ironically, actually pushed on the rents to jump quicker. Because, having managed rents over many years, many landlords just kind of thought, it's fine if I have a good tenant, I'm quite happy. There's no need to upset the apple cart, from my experience anyway. And then when the 4%, came in, people kind of thought they didn't fully understand really the regulations around it. And they started to just really rush to put up rents, kind of feeling maybe that, we won't be able to get good value out of our rents going forward. But look, having said that, compared to other places in the country, it's still, people can still afford it. And we've a huge amount of markets within the Limerick market, if I can say that, Carl. Like you can get a one bed can go from like 550 right up to, 1,200, depending if it's an exclusive development. You can have a 2 bed from 700, because some of them could be historic and they might have got caught in that RPZ and they're limited, mightn't have been fast enough to put up a rent, right up to 1,600. The 3 beds can go from 850 up to 1,800. So the 4 beds from 950 to 2,000, etc. 5 beds from 1,100 to 2,400. So sometimes when you see national statistics, you might know where to look, but if you're local, you can actually see there's a huge gamut of different prices. And I think when the new developments like, Cleves factory and the new residential developments, people will move into those, but there will be other cheaper properties available as well, for other renters. And I think as well, the more new properties come onto the market, people will want the higher standard, even though standards of rental accommodation has, thank God, improved significantly. There'll always be the properties that aren't to the standard or the energy ratings of other ones, and they will be a little bit cheaper as well and affordable.
Okay, in terms of rental, because Limerick hasn't really experienced the build to rent maybe that Dublin has, and Cork to a lesser extent, and it hasn't had the same investment in terms of student accommodation, while obviously there has been some, probably not as much as is required. Where do you see the next wave of investment coming in to build that? Because there are huge ambitious plans by the local authority there. Do you think that will be supported by private development and private investment?
Yeah, well, again, it's the cost of building. It's just, it's so expensive to build. As we know now, in the last 6 months, again, materials are just going up and up and up in price. And there is a lack of passion and excitement from the private builder to build because of margins, really, with between the local housing authorities and, the price of materials, the margins they feel are kind of too small to build. They're not, that is a challenge. It's becoming more government based, the building. So I'm not sure what can be done about that. Having said that, conversely to that, the prices of apartments on the market can't be built for those prices. So that's an attractive place for a first-time buyer to go, or again, it's attractive to outside investors, because they're not going to be built for those prices again. We're still selling in Limerick at prices that you can't actually build them for. So that's another way of looking at the attractiveness of buying in Limerick.
And that type of development then tends to go to private investors, smaller operators, as opposed to institutional investors. And we know en masse across Ireland that profile of investors is leaving the market. In Limerick, but I actually, in one way, I think they're leaving the Dublin market, but actually they're still very evident in the Waterford and Limerick markets. But in terms of new supply coming on for both the private or the new build and secondhand market, since you've been back in the office and indeed during lockdown, secondhand homes, are they coming to the market, or what kind of attitudes are you experiencing from your sellers?
Yeah, what's happening now, I'm seeing, Carl, a lot of, is that people who had been waiting for the right time to sell, and this could be over a number of years, this could be since the recovery, they're going, right, now I'm going to sell. Now, as we know, and rightly so as well, the RTB introduced longer notice periods to tenants. So I am almost certain this goes right across the board with agents in the city. There are a huge amount of notices gone out to tenants in the last number of weeks. Some of them could be up to a year giving them notice. So people who have investment properties that maybe still aren't at the peak price that they paid for them way back in 2005 or 6, they could still be 30% below that because they might have bought them on a tax incentive. Those people are now saying, well, I think this is as good as it's going to get for a certain period for me in terms of the recovery. I'm going to get out now, it's good for them in that they're trying to recoup some of their losses, still huge losses for a lot of those people. But then it's a case of, right, where are the tenants going to go? You're back to that, But secondhand houses, secondhand properties, they are coming onto the market and people are finding it's a good time for them to sell. The trader up, side of the market is doing really, really well. What's happening again now, and it's the first time I've seen it in, I'd say since the boom, that people are actually now going out to look for properties confidently knowing that they can sell their 3 or 4 bed semi in the suburbs and maybe even slightly outside within a matter of weeks. So whereas previously people just wouldn't speculate like that, they're now actually in a speculative mindset again about trader upping because of the confidence they have in. They mightn't have all their funds ready immediately, but they know they can sell very quickly.
And so the pipeline of buyers and finance ready buyers is there.
It is, yeah. And I've seen that in the last, since we've opened up, suddenly, there's all these buyers that have all their mortgage approval, and last year, this time last year, or maybe a month, 2 months back, sales were falling through and mortgage approvals were actually, being taken back. And suddenly, all of a sudden, it's all come together again, whether that work was going on in the background all the time or people just felt, right, we need to get those mortgage approvals through so people can start buying.
Yeah. Have you come across many buyers who are rushing to use the approval in principle that they have because they're concerned maybe that they won't, if they have to reapply, that there might be a change in circumstances? Yeah.
And again, from experience, a frenzy can always be a dangerous sign. Like we all, you often feel that frenzy, but it'll turn around again and something else will happen. And, they will get back on that ladder, because either new builds will come in and they'll be much higher priced and the secondhand stuff will still be there. So, I mean, personally, I hate to see somebody rushing to get a house. I only met a couple yesterday and they looked at a house and it was a first time buy and they were humming and hawing about it. I knew they were, as you said there, in a hurry to spend their money. And I was kind of saying to them, look, like you're probably going to be here 20 years, are you sure you want to really rush this? Is this where you want to bring up a family? Like, are you happy with the garden? Do you like the area? Do you like what you see when you look out? So like, I think people need to be cautious. It is their life after all. And like, don't just spend your mortgage out of fear that nothing else is going to come up. But there is a bit of that definitely in the air, Carol. Yeah.
Yeah, no, look, I'm seeing that not just in Dublin, but actually right across the country, and where it's not driven by maybe mortgage pressure, it's driven by supply pressure, that there's just so little supply in the market that buyers think if they don't take this, there will be nothing else. And you're right, frenzy is a terrible place to be making big financial decisions from.
Yeah.
During lockdown, with the restrictions that were there, did your firm sale agree many properties to people remotely only? Like, did you sale agree many properties for buyers who didn't set foot inside the property?
Well, I suppose the type of properties that we sale agreed during the lockdown were to investors. Okay. So, and they probably would have been an investor that I already had an existing relationship with, that kind of we had the know, like, and trust relationship. And they would say, is there anything going? And I might have somebody that, sold with the tenant in the property, which is great. I love to see that as well. So I might have said, well, this person, instead of serving notice to the tenant, I'd say to them, well, look, if you can get market value, if you want to sell to another investor, they'll keep the tenant, and they would normally say happy days. So we did a few of those. People expanded their portfolio. People who wanted to get out, I suggested them, well, if you want to leave the tenant, I have a buyer. So I did, I suppose, about 5 of those.
Okay. And none fell through when the restrictions eased, because that's one of the things we're tracking at the moment, because there's no data on that. So we're actually, through Property District, we're tracking that ourselves from speaking to agents to see what properties had sale agreed in order to accommodate viewings during the restricted period and have subsequently fallen through.
Yeah. No, I've heard, Karen, like there was, there were, the virtual viewings where people were just, bidding on property. I tried to stay out of that a little bit because I suppose that just taking a more thorough kind of vetting process of the buyer and the potential buyer. Again, I'm the type of person that feels that aside from maybe the investment department where somebody already has one in the complex, is familiar with the OMC, et cetera, they really do need to step foot in the property. And I like to keep that message out there because it's very good for the industry. It's very good for the business of a state agency. And we certainly, me personally, anyway, I certainly don't want to, to put it out there that you can just sell a property and never have to walk in the door of it, because I'm conscious of my own role in the industry, and what we do, and I don't want everything to go just online into a transactional based, setup. But I don't think that will happen anyway.
In a way though, Helen, that nearly brings us full circle to where we started the conversation in terms of the fact that this is a trust-based relationship, that it is always about the people, and that technology really has a role in facilitating that. So, I mean, you mentioned, and I'm conscious of time here that we need to wrap up shortly, but you had mentioned that, during lockdown was the time you embraced not just digital media for your own firm, but an element of putting yourself out there, not just as the company and the business, but yourself, Helen McCormack. And I know that your company achieved some important accreditation over the period as well for thought leadership. What was that?
Yeah, I got a thought leader accreditation in real estate from the All Ireland Business Foundation, which was, a fantastic honour during the lockdown. So it kept the spirits really high. And I'd heard about the All Ireland Business Foundation through, I'd been invited to an event in Croke Park some years ago, and I was very impressed by the calibre of businesses associated with it and keynote speakers at the events. So I kind of thought, since 2016, I highly value technology as well. Carl, we had been implementing systems, processes, to offer a better service to our customers in terms of our management and our sales sector. And I kind of thought, I'd like to go through the process of auditing to see how I come out after having done all that work, And I was delighted then, to have got the 3 stamps of performance, trust, and customer centricity, because I wanted to position our business as having excellent customer service and being able to share our knowledge and guide and assist people in their decisions. And the thought leader accreditation is a nice little flowery addition piece that goes on top of what really is the most important thing, the excellence and the customer service. So I was very delighted with that. Yeah.
Well, congratulations. I think it's a great achievement for your own firm, but I think it's a really important signal for the sector, that the sector is working well with technology, that it all comes down to serving the client, that it is a customer focus and client focused business. At the end of the day, it all comes down to service. So if technology is the tool you use, great. But it comes down to service, it comes down to people. And by the way, again, because my focus is always on the technology, I do appreciate this timely reminder of that. So thank you for that. And also, it's great to get an understanding of what's happening in Limerick, because it is very much coming to the fore in terms of urban regeneration, some really exciting things, projects planned. And I understand what you're saying there, that maybe the passion and the appetite isn't there from the private sector investment yet, but that's surely the next step. That's surely the next step in the process, and it's something we'd love to see for Limerick, because the potential is there. It just needs to be tapped in. So thank you so much for taking the time to talk to us today.
Thanks very much, Carol. You'll have to come down sometime, show you around.
I would only love to. Now the restrictions have eased. That's exactly my plan. That was Helen McCormack, owner of Helen McCormack Estate Agents based in Limerick. We need to take a quick break now. Stay tuned.
93.9 Dublin South FM.
And welcome back to Property Matters on Dublin South FM with myself, Carol Tallon. You can contact us on Twitter at iPropertyRadio or email hello@iPropertyRadio.com. I'm now delighted to be joined by Professor Andrew Baum, Professor of Practice, Said Business School from the University of Oxford. Andrew, thank you so much for being with us today. This is your first time on the show, but your name has been thrown around quite often. You've been quoted quite heavily here in our PropTech section. So thank you so much for being with us today.
It's a pleasure. Thanks for asking me. I've got happy memories of being in Dublin, and it's nice to be back, even if it's just remotely. Thank you.
Well, Andrew, you're very welcome into studio. At the moment, we're recording from home as well, but when we're back in studio, we'd be only too delighted to welcome you there. So, Andrew, as I mentioned, your name will be familiar to anybody who's been listening into the show. We're now in our 3rd year, so yeah, like I said, you've been quoted quite heavily during that time. But you might just give people a little bit of a background, because as I introduced there, you are with the Professor of Practice with Said Business School. But how long have you been involved in the real estate and lecturing in the real estate industry?
A really, really, really long time, Carol. So I went to Reading University to study real estate when I was 17 years old in 1970. I started teaching at the university in 1975. I've got 3 real estate degrees from the University of Reading. Since 1990, I've been working for either 1 day or 2 days a week in the university, whether it be Reading, Cambridge or Oxford, and doing some visiting stuff in North Carolina and Sydney. I was also visiting examiner at DIT in Bolton Street for a while, which I really enjoyed. But for the other 3 or 4 days a week, I've been in business either as a CIO, Chief Investment Officer, or a head of strategy or head of research for people like Prudential, Nuveen, CBRE Global Investors, Invesco, and others. So I continue to have a business interest and a business life, and the classroom is a place where I really enjoy. I enjoy being in the classroom, and I think the students probably appreciate the real life case studies.
Yeah, I've no doubt. I didn't realise that you had spent time at DIT. So were you visiting there?
Yeah, I was the examiner for 3 years, I think, and always great fun. Always great going to the Museum of Irish History and being told that the English aren't as nice as we think we are. So I've really enjoyed my cultural exposure in Dublin, and I'm looking forward to coming back.
Oh, very good. Well, actually, when you are coming back, be sure to visit. DIT is now TU, Technical University Dublin, and the new facility at Grange Gorman is stunning. So you will get a great surprise when you visit that. So I recommend it. But in terms of your background, so it's good that you have that, that you've kind of kept that 1 foot in industry and 1 foot in academia. How important is that when we're looking at innovation at a very real level that can actually impact the industry, and that is readily accessible to the industry? How important is that to have the commercial and the academic focus for an industry as traditional as real estate?
Well, there's a constant tension here. I mean, from my perspective, it's ideal to be partly in business and partly at the university. From the university's point of view, it's not ideal because it needs completely committed academics who are going to publish in the best journals. And to do that, it takes a long time. The average time to publish in a really good journal is probably 2 years. And the world of innovation in real estate might move slowly, but it doesn't move that slowly. You don't want to wait. You don't want to write something and wait 2 years for it to be published. So there's a compromise going on all the time, and I can't be a brilliant business person if I'm only working 3 days a week. So there's a compromise all over the place. But I have to say, I think the benefit of doing both is that I can organize my thoughts when I'm in the university. I can construct a PowerPoint presentation pretty well. And I think that goes down pretty well when you're talking to business people that need their thoughts structuring and being organized. And it works the other way around in the classroom, as I've said before. So I think what happens is you just have to work 6 days a week, which I've been doing for the last 25 years or so, and just work hard.
I think that you'll find that's quite symptomatic of every entrepreneur in the industry, and particularly what we're seeing across the startup sector in prop tech and construction technology at the moment. But one of the things I was really interested about is I first became really aware and involved. I think I learned the term prop tech back in about 2015, but I'd been very passionate about innovation and I'd been in the industry for about a decade before that. So it wasn't so much that the innovation was new, the use of technology was, but there was a lot of new language and terminology around it. But your report in about 2016 was one of the foundational pieces of research. So you might just take us back how you got involved in that.
Yeah, sure. And I think we need to go back to 97, really, 97, 98. I mean, I was working in the real estate industry in London in 96, 97, 98, and the internet came along. So email came along. And, before that, we were actually sending paper letters and all that sort of stuff and using the telephone. So observing the internet, I saw the dot-com boom of 99. And I got involved in the dot-com boom in 99, 2000. The dot-com boom is really best remembered as a dot-com bust. The 2001, 2002 period led to a massive bust. There's a lot of money going into property technology in 1999, 2000. A lot of businesses that survive today, like CoStar, Argus, in the UK, Rightmove, in the US, Zillow, these sort of residential listing sites. They came out of the ashes of the dot-com bust. I started first of all, I was editor of a property encyclopedia in 1999, and we realized about 2 years in that we should really be putting the thing online. And we had to completely redesign our business model and go for an online business information product. In 2001, I also started a database of property funds globally, and that immediately went online. Originally it was CD-ROMs that we were posting out to people, but eventually that became a website, and that still exists today. So I think I did start a PropTech business in 2001, and I call that PropTech 1.0. So that period is PropTech 1.0. Then sort of there's the dot-com bust. We went through a period when people weren't really interested in technology. It was all about money. It was all about bank debt, buying as many buildings as you could. The property boom of 2003, 4, 5, 6, which Dublin is probably the epicenter of it. If you think about it, the boom that was going on was incredible. The amount of bank debt that was being secured was incredible. So nobody was really worried about technology at that time. It was all about debt. And then, the crash, 2008 crash, coincided with the launch of the Apple App Store. And the iPhone 4 was out in 2008. The App Store was launched. And you've got a younger generation who are now skeptical about the way in which the traditional markets can bust themselves. We've got a bust banking system. We've got people that you can't trust running funds. You've got people just taking huge bonuses out of the industry when people are losing their jobs. So, there must be a better way of doing this. So the App Store appeared to be a better way of communicating. And if you think about this is one of my most sort of simple rules or sort of aid memoir is the world is just full of billions of rooms and billions of people. And those billions of rooms and billions of people are trying to connect with each other all the time. We're constantly looking to go into residential accommodation, offices, shops, pubs, bars, whatever. And before 2008, the way in which rooms communicated with people was through brokers, through newspaper adverts, through websites, but it was pretty clunky. And the App Store suddenly gave us this formula whereby people could go through a platform to communicate directly with the rooms. And of course, that's Airbnb. So Airbnb is created in 2008. And it became a $1 billion business, a unicorn, and then we can repeat that formula over and over again. We've got rooms, we've got people, and we've got an app, and that's really the genesis of PropTech 2.0.
Okay, and on that basis, you're talking about a skepticism that existed and perhaps a distrust of systems. I like the distrust may not have been new and the skepticism, but maybe the actions coming out of it were new. So certainly in the early stages for PropTech, what you would describe as PropTech 2.0, we were seeing a lot of consumer-led innovation, and that seemed to be born out of the skepticism and frustration. But already we're seeing just 5 years, 6 years on, already we're seeing a shift towards more industry-led innovation. Is that just something we're witnessing maybe in Ireland and the UK being maybe a little bit behind some of the other trends, or would that really be indicative of how innovation is being driven?
Well, I think there's a natural curiosity amongst the man in the street and the woman in the street about why it's not possible to trade your property in 3 days online. So the mass market connects with real estate through housing, through house prices and house purchases. And what they observe is that although you can go online now to look at the listings, you can't rapidly transact. You've still got to go to a lawyer. You've got to do a lot of work. You need to assemble lots of paper documents. And I think the man in the street is genuinely a little bit confused about why that can't be done more quickly. And if you look at it, it is possible to find reasons why it can't happen particularly quickly. It's just too big a transaction. There's too much risk on behalf of the purchaser. They want to use lawyers because they want the protection of having a lawyer making sure that everything's okay. And if it's not okay, they want to be able to sue the lawyer, or they want to be protected. So the man in the street, I think, as there's been overinvestment in the residential property market, technology, speedy transactions, all that. That's been a bit overblown, a lot of hubris. Meanwhile, however, there is a really good reason why commercial property owners need to innovate. They really need to innovate. The whole long lease structure where a developer builds a building speculatively, sells it to a pension fund that has got no connection with the tenant, and then sort of subcontracts the property management down to a broker or a property management company, means there's no connection between the development of the product and the user of the product. And the word customer then has to come into it, right? So if you're running a hotel, the people using your hotel rooms are customers. But an office developer or an office investor doesn't think about his office tenants as customers. And this is the real revolution. This is what's really going to change, because now with all of the things that have been going on, shorter leases, more power in the hands of tenants relative to landlords because of the creation of massive space, cyberspace. You look at the retail market, there's all this cyberspace now through which we can trade. So the owner of retail property is in a less powerful position than he used to be. So now he's having to think about, well, how do I make my customers happy? What do I have to provide? What services do I have to provide? And COVID has done the same to the office owner. So how are you going to get people back into the office 5 days a week? And what happens if you can't get them back in the office 5 days a week? Do you need to provide wellness facilities? Do you need yoga studios? Do you need great technology? Do you need great coffee? What is it that's going to make your building worthwhile? So we're now entering this phase where we need to connect customer satisfaction with rental values and lease structures. And of course, the WeWorks, the co-working operators have been in the vanguard of thinking about this stuff. And I don't think the market will ever be the same again. We used to have 25-year leases in the UK with 5-yearly upward-only rent reviews. We're never going to see that again.
Okay, there's so much to unpack in what you've just said there, but let's start with the most recent and work backwards. In terms of commercial property and the long leases, I fully accept that there is a strong demand, a desire for more flexibility, and that flexibility inevitably means shorter term leases. Although I am recalling a masterclass delivered by Anthony Slumbers, who obviously would be well known for speaking about space as a service. And, one of the things he noted through his research and through research that's available is that short-term or long-term leases are getting shorter, but the short-term leases are actually getting longer. But in terms of the commercial property long-term lease structure, how do we reconcile what the market wants with what funders and landlords can afford to do? Because I think sometimes when we have this conversation, there needs to be an understanding that each cog in the wheel has a financial master. Everybody is accountable to somebody. So how can we make the shift that the market wants in relation to the commercial lease structure and still make it viable?
Yeah. Well, I don't think this is as big a problem as some people possibly feel it is. I think you've got to look at the equity provider and the debt provider differently, I think. So the equity provider has nothing to fear. If you produce a good product, then the fact that the lease is short should not be an issue. The relevant data that you need to then focus on is how quickly do people release the space? What is the dead period? What's the downtime between leases, between the lease end and the new lease? If you start focusing on collecting that data and understanding how it works, you'll generally be pleasantly surprised. The amount of vacancy at the end of a lease is generally short. People generally renew their leases. Tenants generally don't operate break clauses. There's a lot of inertia and a lot of reasons why people want to stay in the same space. So landlords need to be much more confident about the product that they're offering and short leases. If that's what people want, then you'll find that your occupancy will be surprisingly positive. Debt providers might have a different view, but they need to catch up with the idea that these things are, living assets. They need to be, a 5-year debt term is long enough for a 5-year lease, and that's probably the match. In the past, I think there's been some dishonesty, really. I think people have tried to use long leases to avoid the inevitable refurbishment cost that they know is coming around the corner. And the old way that a London landlord would think about this was, well, let's build the building, let's build it as cheaply as we can, and let's let it on a 25-year lease to JP Morgan and then sell it to a pension fund at a big price. And they're getting it off their balance sheet, right? So they're shifting it onto somebody else's balance sheet. Then the poor old pension fund comes along and they've got it on their balance sheet and they've got a 20-year lease. And at some point down the road, they've got to choose when to sell the building to avoid the big refurbishment cost that is down the road. And either they don't, and they end up with an empty building, which is 25 years old, which needs complete demolition and rebuild, and their performance turns out to be awful because they bought the depreciation, or they try and get rid of it 10 years early and pass it on to somebody else. But somebody's going to have to pay that price, you know. And you know, it's much better to have short leases so that you recognize the fact that every year you need to be spending money on the building, just like we do on our houses. You know, you don't want to buy a house, leave it for 30 years and then find, oh my God, I've got to replace all the windows, replace all the doors, replace the bathroom, replace the kitchen. You need to be doing it on a rolling basis. And that's good for the environment. It's good for the economy. We should be retrofitting everything on a regular basis to produce buildings that are fit for purpose and that will be resilient in capital value terms. So none of this build, let it become obsolete and then worry about it later. You know, that's gone.
Do you think it's two different conversations we need to be having? You know, on one hand, office buildings, and on the other hand, retail, because the changes in retail are different to the changes in office. While they're both changing a lot, it feels at this stage the rate at which they're changing and the direction in which each are going respectively, it feels like they're going to end up in very different places, where retail is going to be more online, whereas offices are going to be more experiential. And that's something that maybe we might have used to describe retail trends. But, you know, just for example, I was reading there in The Guardian last week about, I think it was in somewhere in the UK, a Debenham store was taken over by a university, and it has been a department store. Like prior to Debenham, it had been a department store for more than 100 years, and now it's going to be used as a training facility and tuition rooms as part of the university for healthcare students. And it definitely got me thinking about alternative uses for some of these core retail buildings in town centres. You know, so are these changes that are coming, and that's obviously going to have an impact on lease terms?
There's a great book, Rethinking Real Estate, by Dror Poleg. I don't know if you've seen that. I'm sure you have. But you know, his analysis of the retail market is really interesting. You know, retail has been has always been in flux. You know, there's always been innovation in retail. It's just constantly moving. You know, shopping centres in the UK are not that old. You know, they've sort of covered in-town shopping centres not that old. Retail warehouse parks are pretty new, you know. So there's always innovation and change going on in the retail market. I mean, I think you're right that there is continuing change, and it's a real challenge thinking what to do with shopping centres right now. I suspect they're going to be more experiential, just like an office building will be. And, you know, a lot of retail property owners are thinking about that. The really difficult ones are where the rental value is clearly falling and in free fall, and the operating costs of those shopping centres remain quite high. And so you've got a real problem there in making money out of them. And it'll be interesting to see whether they offer opportunities for last mile logistics or for residential or experiential, you know, entertainment, whatever it's going to be. But that is a challenge. There's no doubt that's a challenge. I'd be more comfortable with a retail warehouse park than an in-town shopping centre right now. So that is a challenge. There's no doubt about it. But it's worth bearing in mind that the best performing property sector for the last 10 years has been high quality retail in Europe. It's not a complete dog. You know, shops in Bond Street are still selling on 3% yields. Yeah.
Just because you've mentioned Dror's book there, Rethinking Real Estate, and on the subject of rethinking real estate and the future of it, your own university is launching a new programme. Can you tell us a little about that?
Yes, thank you. March the 31st, we're launching a programme called the Oxford Future of Real Estate programme. It's an online programme. It takes spread over 6 weeks. So you spend about 7 or 8 hours a week for 6 weeks on 6 topics, including the future of the commercial property markets, the future of real estate investment, and so on. It's about €2,000, and anybody can sign up for it. So it's the Oxford Future of Real Estate programme.
Very good. And can you give us a little bit of insight about the kind of things that will be covered on the curriculum? And that's really a roundabout way for me to hear from you without paying the €2,000 for the course and spending the time. What are the trends we're likely to be seeing? Because I remember reading a lot in early 2020 about the trends we were likely to see. And I am exhausted by the cliche of the pandemic accelerating trends. And I think that's an oversimplification. We're definitely seeing a shift. We're seeing a shift away. So it's not just an acceleration of trends, but where I suppose, given that you're working with research teams here, what kind of insights are likely to be shared?
Well, the big change. The first unit's about the property universe and the mega trends that are going to be hitting it, and a lot of those are pretty deep seated. Globalization, demographics, migration, housing shortages, growing wealth divisions between the rich and the poor. All the impact, social impact, and the big one, climate change. So all of those things are much bigger than the COVID effect. And the first module will be considering those things before we move on to looking at valuation, finance, investment in a not a traditional sense particularly, but just thinking about how you model these things. Before we then look at the commercial property markets, the future of retail, future of office, future of logistics, then the housing markets. How do we build enough houses for everybody, and how investable is social housing, for example, which is one of the most attractive investment propositions I've seen in the last 3 years was affordable housing in Dublin, and that's a great sector to invest in. Then the fifth module is about development, sustainable development, developing regenerating cities, smart buildings, and climate resilience. And then the sixth module is all about building a resilient global portfolio. So if you had £1 billion to invest, where would you put your money? And it wouldn't look like a traditional real estate portfolio. It wouldn't be 40% retail, 40% office, 20% industrial anymore. It will look completely different. And so the students are asked to think about what product would they create to sell to big investors right now.
Okay. Do you see PropTech actually figuring into that? Like, are we going to see people who might ordinarily have invested in real assets maybe begin to look at investing in the technology supporting those real assets? Absolutely.
Yeah. So PropTech's like the writing in a stick of rock, goes all the way through it. It's just fundamental now. Technology is the opportunity we have to produce more efficient buildings, more energy efficient buildings, reduce carbon, produce more satisfying urban environments. The whole thing is technology focused, and we have to take it extremely seriously. Amara's law says that we overestimate the impact of technology in the short run, but we underestimate the impact of technology in the long run. And we're rapidly getting close to the long run now.
Yeah, I've always thought that idiom really explains. I think it explains the unexplainable, which is human behavior, and maybe that's something that has been accelerated by the pandemic. The culture shift that has to happen, because I think that's the thing we tend to underestimate, and yet that's the thing that slows progress. It's the human factor, the resistance to change, the needing to be convinced, and I think that's something that might have been very strong prior to the pandemic that maybe has been weakened somewhat.
Yeah, I mean, I think human beings do adapt without realizing. So investment committee papers, we used to get paper maps. We used to get descriptions of where somewhere is. We don't do that anymore. We just go onto Google Maps and we zoom in on the building. We get a picture of it from the air. We can do the street view. We got the whole thing on technology. We're using Zoom right now. That's going to be something we're very comfortable with. We're using a lot more technology than we actually accept we're using. It's part of our lives all the time. It's just step by step. We're just getting more and more technologically competent. Although I'm not as competent as I'd like to be, obviously.
Well, I something tells me there's still opportunity. We still have another while to go in lockdown, or certainly restrictions. So actually, I think there'll be plenty of opportunity to get even more familiar. It occurs to me that a lot of the curriculum of the course, it's coming back to the UN's Sustainable Development Goals. There's a huge crossover there. There are so many social moral, environmental reasons for us to be adopting those as an industry. Have we established the business case for that? Do we need to?
Without any doubt at all. You know, I remember talking about sustainability 10 years ago, and it was a word that I can remember using it thinking, well, I don't really get this stuff. I don't really buy it, but I know I'm supposed to talk about it. There's no real evidence that it's going to add any value to my portfolio if I prove that I'm producing sustainable buildings. You know, it was just the right thing to say and do. Now, there's just no question whatsoever. You know, the idea that you need to compromise your return in order to do the right thing, I think that's gone. You know, I think, you know, if you just look at the, you know, sort of, if we go for zero carbon by 2030, for example, if you want to be carbon neutral at 2030, if you buy a building now in 2021, you'll be selling it into a market which is thinking about 2030. And so the value of the resale value of a building, which is not going to be energy efficient in 2028, which is when you're going to be selling it, you're going to be hammered. So it's already in the decision making. It's not pie in the sky anymore. It's not liberal wishy-washy thinking. It's right in the hardwired finance world now that, you know, you have to produce ESG acceptable buildings, portfolios, business practices. I chair a fund management business in the UK called Newcore Capital. We've just been certified as a B Corporation. It means that we have to run our business according to sustainable business principles. 10% of our profits go to charity, et cetera, et cetera, et cetera. You know, that is going to help us enormously in raising capital. It's going to help our business because pension funds need to show that they're doing the right thing. And if we're going to win mandates, we're going to win it from people that have got the right ESG motivations, and they're looking for managers with the right ESG motivations. We're only going to buy buildings from developers with the right ESG motivations, and so on and so on and so on. And occupiers are only going to take our space if it's healthy, if it's energy efficient, and if it's not throwing out carbon into the air. So the whole that game is now, everything's aligned beautifully, and Greta Thunberg's done a great job. COVID has helped. I think it's just accelerated things a little bit. But there's no doubt that the big issue for the next 5 to 10 years is all about carbon. It's all about environmental performance. And the property market has that issue, you know, front and sideways everywhere. You know, it's the big thing that we've got to cope with now.
Yeah, no, look, I absolutely agree. And in fact, I had the pleasure of speaking to Michael Beckerman and about the launch of Cretech Climate. So that's a global initiative to try bring the industry together and align on some of the actions that need to happen. So, you know, there are some great global initiatives happening at the moment. Before I let you go, you mentioned something to me, and I really, you know, I'd love to get some kind of clarification around it. You mentioned there that, you know, you feel maybe the prop tech aimed at the residential market and maybe the consumer market might have been at this point, it might be a little bit saturated, but at the moment we're still seeing a lot of ad hoc, you know, not a great amount of cohesion across some of the consumer facing technology. And you mentioned that it might be the curiosity of the man in the street as to, can this be done better? And I agree. I think there is curiosity and confusion, but is there a level of acceptance that when it's a big transaction, for many people, it might be, you know, buying your home or getting your mortgage might be the biggest financial commitment of your life. Is there somehow an acceptance that it's okay not to embrace technologies? Is that a problem, or is this just something that you think technology and time is likely to align people's expectations, and they will just get used to doing all these transactions online, like even like consumer facing ones?
It's a big question. I sort of the reason why transactions will not be instantaneous and online and costless for quite a while is that, number one, we need digital data about the homes. In the new build market, we're capable of producing digital, property passports, digital twins. it is possible to create a digital pack of information which describes everything there is to know about the house, from the architect's plans through to the, the boiler units, manual, whatever. Everything can be digital and handed over in a pack. But that is not going to work for 95% of the existing property market or housing market, because the houses don't have that digital record. The house I'm sitting in right now was built in 1880. There's no way I've got a digital architect's plan of it. So that's going to be slow. And the second aspect is that caveat emptor is the rule that we're working with. The buyer beware. And so the buyer is going to be very careful before, instantaneously transacting on a £1 million or euro building. So we're going to go carefully down this road. It's going to be somewhat slow and painstaking. On the other hand, there's no doubt that we will start to assemble digital records, and those digital records will be much more efficient. And at the same time, you're going to see the big tech companies like Amazon, Google, and others having a very subtle but insidious impact on the housing market. So Alexa, for example, is going to be in the home. And once it's in the home, it's going to be collecting information about the home. And that data feedback will be used to produce more efficient housing. Facebook are already building affordable housing for their employees. I think you're going to naturally find that the big tech companies start to get more and more involved in real estate. Google's built its European headquarters in St Pancras. These things are just getting closer together all the time. So once the big tech companies get involved, then you will see some real change. But don't expect it to be rapid for 95% of the housing market, because we're dealing with assets with no digital information. Somebody asked me about somebody asked me about a building that I'd owned a couple of years ago, and said, could you assemble all the information, the fire safety certificate, the smoke alarm detector stuff, or whatever it was, and could I find any of the paperwork? Was it on my computer? No. Was it in my filing cabinet? Yes, some of it. Was it my wife's filing cabinet? Yes, some of it. Was it in our lawyer's office? Yes, some of it. I mean, it's a mess.
It occurs to me that if there was a value in having a second asset, albeit a digital one, in the same way digital twins will be a second asset when design and build teams are handing over an asset to their client, if there was value in that, we'd find a way to make it happen very quickly.
Oh, that's for sure. And there are people out there who are definitely trying to think about that. How do you incentivize people to produce digital property passports? What's in it for them? And I've seen several failed attempts, and people will keep trying. Facebook for houses is one of the ideas. Why wouldn't every house have its own Facebook page with its history? Who owned it before? What parties have you had in it? Who lives nearby? What are the cafes like? There's going to be the potential is there for creating a site for every house in Ireland, every house in England. And why do you need to put a house on the market? Why wouldn't you just say, I want to live in Ballsbridge? Is it Ballsbridge? Dublin 4, mm-hmm. Right? So, yeah. I want to live in Ballsbridge. That's my favourite street. Why wouldn't I just make an offer on all the houses in that street and see what happens? That's possible. That's technically possible. So I can see us going that way. But what needs to happen, as you've quite rightly raised, is what is the incentive for people for loading all this data? And it may simply be that somebody's going to make you an offer without you asking for it. Somebody's going to, have you ever had the situation where somebody's put a postcard through your front door letterbox saying, I really want to live in this street, would you sell your house? And it's quite arousing, if you don't mind me using that word.
Well, no, I'm afraid I was the person who was putting that note through the letterboxes for about a decade. So I see the benefit of the hybrid on and offline approach. But listen, thank you. So you've been so generous with your time. I suppose the final thing maybe to ask, and maybe this question is answered through the Future of Real Estate course, but has the pandemic created any shift in the trends that you were seeing for PropTech in 2021 and 2022?
No. I suppose there's a sort of an obvious unicorn, which is going to be a health monitor for buildings, which probably lines up with a health monitor for people. So I can see that I suppose this is an idea I didn't have a year ago, that, I suspect I'll be having a wearable which will give me access to a building. And if the alarm doesn't go off, then I'm allowed into the building. And if I'm walking up and down a street in Dublin looking for a bar to go into, I might in 2030 be looking for a dial on the outside of that room that tells me that the air's good and that there's not a lot of COVID floating around in the air. And so, that sort of health tech being applied to buildings is probably an accelerated technology invention that we will see more of.
Very good. Andrew, again, thank you so much for being so generous with your time, and best of luck with the course. I look forward to monitoring as well the cohort that goes through that course, and hopefully we'll be talking to them about their innovations. That was Professor Andrew Baum of the Professor of Practice, Said Business School, University of Oxford. That's it from us this week. Thank you for listening in to Property Matters on Dublin South FM. You can get in touch with the show on social media at iProperty Radio or email hello@ipropertyradio.com. Also, my thanks to Peter Rice on sound. We're back at the same time next week. For myself, Carol Talon, and all the team here, stay safe.